Where should your very first investing dollar actually go? If you're tired of hearing 10 different answers and still feeling stuck, this video is going to finally make the options clear. Quick disclaimer, this video is for educational purposes only. This is not financial advice. Let's start with the basics. When you invest in the stock market, you're buying tiny ownership pieces of companies. I like to picture the market as a giant pizza made of thousands of businesses. When you invest, you're taking small slices of that pizza. If those companies grow and earn more over time, your slices can become more valuable too. Most people invest for long-term goals, retirement, a future home, or simply growing wealth over decades. In the short term, prices jump around a lot. Some days are up, some days are down, and sometimes it feels chaotic. But the goal isn't to guess every move. It's to ride the long-term growth of many businesses over many years. One word matters a lot here: diversification. Diversification simply means not putting all your money in one place. Instead of betting everything on one company, you spread it across many. That way, if one company struggles, it doesn't destroy your entire plan. Keep that idea in mind because it's a big difference between index funds, ETFs, and individual stocks. So what exactly is an index fund? Imagine a list of companies that represents a piece of the market, like a list of many large US companies. That list is called an index. An index fund is a basket of investments built to copy that list. Its job isn't to beat the market, it's to match that index as closely as possible. When you put money into an index fund, you're buying a tiny piece of every company in that basket at once. That gives you instant diversification. You're not trying to pick winners and losers. You're saying, I'll take a slice of all of them. Many index funds are designed to be simple and low cost, which is why they're often used for long-term, set it and mostly forget it investing. That doesn't mean they're right for you specifically, but it explains why they're popular. Now let's talk about ETFs. ETF stands for Exchange Traded Fund. At a basic level, many ETFs look a lot like index funds. They hold a basket of investments and often track an index too. The big difference is how you buy and sell them. An ETF trades on the stock exchange during the day, just like a regular stock. The price moves up and down throughout market hours. Some people like ETFs because they combine the diversification of a fund with the flexibility of a stock. You can see live prices, place different types of orders, and choose from a huge menu of options. But that flexibility can tempt beginners to trade more than they need to, which can increase costs and stress. Fees and taxes can vary by ETF and by country, so it's important to read the details and, if needed, talk with a professional. For our purposes, just remember, an ETF is usually a basket, often similar to an index fund, that you trade like a stock. Finally, individual stocks. When you buy a single stock, you own a small piece of one specific company. If that company grows, launches great products, and makes more profit over time, its stock price might rise, and you can benefit. You might also receive dividends if the company chooses to share profits with shareholders. The appeal is obvious. Pick a great company early, and your investment can grow a lot. But the risk is higher too. If something goes wrong with that company, your stock can fall sharply. Your results depend heavily on just a few businesses, so you're much less diversified. Stock prices can swing wildly on news, earnings, or even rumors. Successfully investing in individual stocks usually requires more research, more attention, and a strong stomach for ups and downs. So how do these three options stack up next to each other? In terms of diversification, broad index funds and broad ETFs usually give you the most in one move. You get exposure to many companies at once. With individual stocks, diversification depends on how many different companies you hold and how different they are. Owning one or two stocks is very concentrated. Owning dozens, carefully chosen, takes time and effort. On risk and volatility, nothing is risk-free, but broad funds tend to move more smoothly than individual stocks because they average together the good and bad news of many businesses. A single stock can jump or drop sharply in a single day. If big swings stress you out, a broad fund may feel more comfortable than a handful of individual names. With fees, many index funds and broad ETFs are built to be relatively low cost, especially those that simply track a market index. Lower ongoing fees can make a real difference over decades. Individual stocks don't have annual fund fees, but you may face trading costs depending on your platform, and frequent buying and selling can add up. On simplicity and time, index funds are usually the easiest. Choose a fund, invest regularly, and focus on the long term. Many broad ETFs can also be simple if you treat them the same way. Individual stocks are the most work. You're responsible for researching companies, staying updated on their news, and deciding when to buy or sell. So, which one might fit you better as a beginner? If you like the idea of owning a lot of companies at once, want something you don't have to babysit every day, and are thinking in years rather than weeks, you might lean toward broad index funds or broad ETFs as a starting point. If you want that same diversification but really value the flexibility of trading during the day and placing different order types, you might be drawn more toward ETFs that track similar indexes. If you genuinely enjoy researching businesses, reading financial reports, and you can emotionally handle big swings in value, you might decide to use a small portion of your portfolio for individual stocks while keeping the core in more diversified funds. There's no single perfect answer. Two people can look at the same information and reasonably choose different paths. What matters is finding a mix that matches your goals, your time horizon, and your tolerance for risk. To help you decide, ask yourself 3 questions. First, how much up and down movement can I emotionally handle without panicking or wanting to sell at the worst moment? Second, how much time and energy do I honestly want to spend researching and managing my investments? And third, what is my main goal right now? Long-term growth, income, or something else? If this video helped you, please like and subscribe for more.